Hello, in this presentation we will enter transactions for the payment of bills into our Excel bookkeeping problem, keeping in mind how this same information might be input into accounting software such as QuickBooks. If you would like more information about the QuickBooks Pro, take a look at our comprehensive course in the link below. We're going to first look at how this could be entered into QuickBooks and accounting software, and then jump over to Excel and put this same information into our Excel worksheet. When considering QuickBooks, we're looking at the vendors section here, and what we're saying is we're paying off the bill, meaning we're paying something on account. If it were a book problem and we were to be doing a journal entry for a book problem, it would be saying something like we paid cash on account, meaning we're paying off a bill that was recorded in the past. If we see that in terms of QuickBooks flowchart, it means that in essence we entered a bill here and now we're paying off the bill. So it's already in the accounts receivable and we owe this individual's money. And then in QuickBooks we can just check off this pay bills item and then select which bills we want to pay. Meaning if we select this item, it's going to give us a list of bills that we have entered over here which have not yet been paid, typically entered over here, which have not yet been paid. So if we scroll down, then we only have one at this point in time. We're going to say, this one bill that we have out is for $15,000. We have not yet paid it. We're going to pay it at this point in time. And QuickBooks gives us a nice quick way to check this off. In essence, all we're doing here is writing a check. So when we do this, when we check this off and we go down here, we look at the method. It says we want to write a check. We can either print the check or assign the check number. In essence, we're writing a check in the accounting software using this process. The nice thing about this process is that it can write multiple checks. So if we had multiple bills, we could just check them all off, and then QuickBooks would just write the checks and do it all automatically, which would be nice and fast and great. So what we're doing then, when we see this screen, is we're paying off a bill, paying off accounts payable with a check. We're making a payment on account, and therefore we're going to reduce the cash account and record the reduction to the accounts payable account. No effect on something like expenses from this transaction. And once we select pay selected bills, QuickBooks will in essence generate the checks for these and write those checks and apply them out. The reason QuickBooks can apply them out, and it's a little bit more complicated than just reducing the accounts payable and writing the other side to the decrease in cash, is that QuickBooks also has to track individual vendors and go to this vendor, in this case the Epiphone vendor, and say that I'm going to also have a subsidiary account and show how much is owed to that particular vendor. And by us giving QuickBooks the vendor, it can automatically reduce the amount owed to the vendor as well. When we put this information into our system, we're going to have to do the normal journal entry for closing out an account or payment on account, reducing accounts payable, reducing cash, but also needing to track the accounts payable by vendor, showing that we owe, in this case, Epiphone, part of our accounts payable, that $15,000. We need to reduce their balance as well. We'll see what that takes now in Excel. Here we are in Excel. We are, in essence, remember, the journal entry we're doing here, if we saw this in a book problem, would be that we're paying off making a payment on account, meaning is cash affected? We're going to say, yeah, the checking account's affected. We're going to write a check. We're going to write a check, and therefore we're going to decrease the checking account. This has a debit balance. To decrease it, we'll do the opposite thing to it, which is a credit. So we're going to copy this here, scrolling down to the next area we have. The date's going to be the same, 1/28, and we're going to put this on the bottom. So we're in Q27, right click and paste 1, 2, 3. The amount's going to be for $15,000, so we're in S27, credit $15,000. Then we're going to debit something for that same amount. We are in S26, negative of this number. We could just type in a positive 15,000, but that's kind of our plug formula. The more we can use the formulas, the better. This is going to be the account we need now. All we need to know is that other account. Now, the question here, oftentimes when we think about this, we start thinking, well, why did I pay the $15,000? Is it some type of expense that we've got, or possibly inventory that we purchased? And it is in essence, but we did that in the past. And now, of course, if we're paying it off on account, it means that we owe someone money for a transaction happened in the past. That then is a liability of accounts payable. So accounts payable represents a liability, which means something happened in the past. In this case, we purchased inventory, guitars, that we then plan on selling in the past and incurred the liability. Now then, we are paying it off. We already know that we're going to debit this account because we credited cash. That's the beauty of thinking of cash first, even if it's going to be on the bottom, even if it's the credit portion of the journal entry. But we want to think through it now. We see accounts payable here representing people owing us money. They then paid us that money, and therefore this account needs to go down. How do we make something go down? We do the opposite thing to it than its normal balance. This is a credit. The opposite is a debit. We will debit this account to make it go down to 0. So we're going to copy the accounts payable, scroll down. We're going to put that in cell Q26, right click and paste 1, 2, 3. Just for formatting, we'll put our cursor on the checking account, go to the Home tab, go to the Alignment group, and increase the indentation. There's our journal entry that we have journalized into this blue area, the General Journal, which we will now post, the process of posting to the General Ledger, which will then be used to create the trial balance and then financial statements. So we're going to first post this accounts payable. It's going to be our first orange account, our first liability. It's going to be in the same order, assets and then liabilities, on the trial balance as in the General Ledger. Let's freeze the panes to make this a bit easier. We're going to be up here in AJ1. We're going to go up top to the View tab. We're going to go to the Windows group, freeze panes, and freeze the panes. Then we're going to scroll over looking for that first orange account. We're scrolling over, looking for the first orange account. There it is. There's the first orange account. And we're going to scroll down and we're going to debit that in AY16, so we are in AY16, equals, pointing to that 15,000, brings this credit balance down to 0. Scrolling back to the trial balance, we should see that same 0 on the trial balance. So there it is, back to 0. Then we're going to record the other side, it to the checking account. There's the credit to the checking account. Here's the checking account, has a debit balance in it. And it's the first account, so it's the first account on the General Ledger. We're going to scroll down. We are in the credit side in AN23. Within AN23, we'll select equals, point to that 15,000. This debit balance then is going to go down to 98,606. That then something found also on the trial balance. So there's that. Now, note that we decreased the accounts payable account to 0, and we also need to track that not just by when things happened, as is done in the General Ledger, but also by who we owe the money to. So the fact that we decreased this to Epiphone, our vendor Epiphone, means that we need to track it in a subsidiary ledger similar to the subsidiary ledger we have been using for accounts receivable. So we're going to go all the way to the right and see that subsidiary ledger listing this amount out, which is currently 0, but we need to make it 0, by vendor or people we owe, people we buy from. So we're scrolling all the way to the right. We're scrolling all the way to the right. We're going to see more orange accounts next to the accounts receivable subsidiary ledger at some point, hopefully. And that's going to be way over here in columns starting with CZ. So here it is, Epiphone, here's the accounts payable subsidiary ledger. And if we scroll down, in essence, we're just going to record this again to another kind of trial balance, another kind of general ledger, I should say. But it is a subsidiary ledger instead of being broken out by date, now broken out by first vendor, who we owe, and then date. So here we just owe Epiphone, but we owe them 15,000. We paid it off now, which is nice. We're going to say equals and scroll down, and we want that debit. And that'll bring the balance down to 0. And now if we add up all the vendors, of course, we owe nothing. And that nothing is now on the trial balance as well. So let's scroll back to the trial balance in the balance sheet to see the nothing, which is actually a good nothing this time. The nothing is good. So scrolling back, and we see the good nothing there, the good 0, meaning we don't owe any money on the payables, and the good nothing there, the 0, meaning we don't owe any money on the payable there as well. We'll see the effect on the financial statements by first we'll remove the freezing of the panes, go into the View tab, the Windows group, and freeze panes, and we will unfreeze the panes. And then let's take a look at the financial statements, which have been adjusted, and see what happens to them. I'm going to go ahead and point to them by going to the checking account and then point that to the financials, and then the accounts payable and to the financials. And let's see what happens to them. We're going to scroll to the right, and the financials will be updated automatically as we enter this data into our system. Scrolling over, we see that cash has been updated and the total assets equal liabilities plus equity, so that looks good. Accounts payable is now down to 0. It's been all done automatically, as can be done in automated systems such as QuickBooks. No effect on the income statement from this transaction. We already paid for, it looks like, the inventory in the past, and now we're just paying it off. So we have that same loss in this case of the $755 that was there before this transaction. That be included on the statement of equity, that resulting in part in the ending balance in owner's equity of $149,642. That amount then found, of course, on the balance sheet here under equity $149,642.